Tim Sykes is a good guy to watch on YouTube. He's got some usually all of his students, the ones that make a lot of money, they're actually using a lot of money. That's why they're making the type of amount of money they make. It takes a lot to make a lot, but your best bet right now is to start out with a small account like you have. I would even bump it down to $500. Learn the most you can, especially right now. It's very volatile, the market, especially penny stocks, things that you can buy a lot of shares in. That's what I like messing with because it is volatile. You want to start out with a small account, something like $500, something like that. You want to learn a lot right now. It's not about making the most money as you can right now. It's about learning. I've made a lot of mistakes by trying to go too fast. That's what it sounds like you're trying to do. By going too fast, you make a lot of mistakes. You learn from those, but it's better to learn and not lose a lot of money, but basically do a lot of learning right now. And then you can up it as you go. The more you learn, the more money you can put in. That's what I kind of did. Crystal gave me her retirement account from her old job, had 15 grand in it, and I turned it into 27. I added up to 32, but the market fell a little bit. It's down to 28 now. I made almost $800 last night or yesterday, but that's just kind of the bigger the numbers, the bigger the amounts gained are going to be. So I'm going to go over some of the stuff you probably will get some good use out of. Again, you want to start out with a small account. I think right now your stocks are, you have too many, and you have too small of shares into each account, into each symbol. So probably want to go to around 5 to 10 stocks. Only kind of focus more on those 5 to 10, when to get in, when to get out, instead of just having a little bit of everything. It's good to diversify, but you want to make sure that you don't have too many, and then stocks are falling and climbing, and you should pull out in certain areas. When I started out, I did the same thing. I just wanted to get in a little bit of everything and put a lot of money into my account, but that's where I kind of went wrong in the beginning and didn't really see the traction that I got now each time I traded. So the most important things, I got some stuff written down here, is build a watch list. You want to make sure you create a good watch list. I have 50 to 100 different ticker symbols, which are SPYI, IBIO, stuff like that. I got the different ticker symbols. Watch them daily, kind of just when I go to work, look at them. At lunchtime, if you get a chance, look at them. You want to find out what kind of trader you're going to be. Penny stocks, they move very volatile, so you work. You don't have time to look at your phone all the time. I would say you'd probably be a long trader, or what I call a swing trader. Day traders usually trade the stock, they buy into the stock, and then the same day they trade it. You got to have over 25 grand in your account to do that without getting penalized, and I'll talk about that in a minute. Anytime you're messing with penny stocks, the price can go, well, you want it to be volatile so you can buy in and get out and get your profits, lock in your profits. So you just want to make sure that you find out kind of what trader you want to be, or what makes it the most profitable for you. If you're working all the time, Monday through Friday, the market opens at 9:30, closes at 4. You're probably going to be a swing trader, which means you buy a stock, you hold it for a day, 2, 3, maybe 4 days. As long as a week, don't hold it longer than that. That's what they call bag holders. And usually you just sit on a stock if it's not doing much. So you want to cut losses quickly. If you listen to any Tim Sykes videos, that's what he's going to say. Is that's the number one rule, and I've found that to be very true. You cut losses quickly. If you find out you're losing for a certain stock, it's not doing what you thought it would do, it's not doing what the chart tells you it should do, there's probably something going on with it. See the different trading platforms, I'll go over those more in detail. Robinhood, Webull, and then I use Charles Schwab as well. I use all three. They all have the advantages and disadvantages, so you might want to find out which one works best for you. I'll go over those in another video. The day trading pattern you want to stay clear of. If you do day trade, if you trade the same stock, you buy a stock in the same day you trade, you sell it. It's called a day trade. You only get 3 of those each week in a 5-day trading period. So you just want to make sure you don't they'll suspend your account if you do more than 3 day trades in a week. Up to 3 to 5, like I said before, 3 to 5 stocks is kind of what you want to aim for to have at all times. You want to diversify, and it's a good thing to not put all your eggs in one basket in one stock or 2 stocks. But I would say 3 to 5 stocks, and probably no more than that, just because again you can manage them a little bit better if you don't have 20 different stocks and they're moving all the time, and that's a good way to kind of not stay managed good in your account. And don't overtrade. You want to go fast, make it a little bit of money. It's very exciting. It's addicting. I overtraded. I got a lot of different stocks. They started falling. I got some stuff I got in some gas stocks. I made about $3,000 in the gas company. Then I got happy with it. Thought I could make more money in the gas company. And then, of course, Trump. Right now, with everything going on, the gas has plummeted. Some stocks have went down significantly. So I've lost quite a few thousand in that. Probably I'd say 2,000. So out of the 3 I made, now I've lost 2. So still made $1,000 on it. But that's the thing you got to kind of watch out for. You can't get overly confident. You kind of just stay with what works and follow the rules. Talked about diversifying already. Cut losses quickly. You don't want to hold it for more than 3 or 4 days. Watch out for reverse splits. If a stock says, a lot of people in the comment section, if it says it's going to reverse split, that means they're diluting their shares. They're going to take so the 1 for 100. So basically every share that you have, or every 100 shares you have, now becomes 1, and they raise the price. So usually they go down because they're diluting the company, giving more shares out at a lower price. So it's usually never a good thing. Sometimes they do it for, if they're doing a pharmaceutical company is doing some research or something, they need some more money to raise more money. They'll ask more from shareholders, and that's the reason they do the reverse stock split. You want to kind of stay away from that. Usually the price gets to dropping pretty significantly when they do an RS is what it's abbreviated as, reverse split. That or an offering. They do an offering, same thing. They're trying to raise more capital or more money for their company through shareholders. Me and you basically are shareholders. So they would usually give a certain price, and it's lower than the price it usually is trading at. They'll offer that to people that want to get in at that price at a later date, and usually the share price drops significantly when an offering comes out. So you want to watch out for that too. If an offering comes out, you want to again cut losses quickly on something like that. Pharmaceutical stocks are probably the most volatile. A lot of times somebody will come out with new technology, or their trials will go good. The stock will shoot up and maybe 50 to 100% in one day. If it goes bad, if they miss the primary endpoints, they're doing trials and it don't go well, someone dies, for example. I've seen one, something like that happen, something crazy. Usually the price shoots way down, and it drops more than it would gain. So pharmaceuticals are good. I've made a lot of money on pharmaceuticals, but the only bad thing about them is it can drop overnight pretty much, and you won't really be aware of it, and then the next day you've lost a lot of money. So it's like a lottery ticket basically on pharmaceuticals and gas, energy stocks. All these are very, very good for profits, and again, they can drop really fast on you as well. So if you wanted to play the high risk game, high risk, high reward, pharmaceuticals, gas, energy, right now, especially with the election, Biden, weed stocks. I don't really believe in the weed stocks like a lot of other people do, but put your money into something that you do want to see succeed as well. You don't want to put your money into something that's a bad company, or that you can read up on. You do your own research on a lot of these stocks and find out what's best for you, and what you make the most money on is trial and error a lot of times. You'll find out what's working, what's not. Find a good sector that's got. Robinhood's really good for showing you the different sectors that you can buy in, like energy, gas, pharmaceuticals, education, whatever the sector is. It's hot. They'll have that up there as well. So they're pretty good about giving you your information on that you need. Different patterns I like trading is first green day patterns. I usually scalp. That's kind of the way I trade. I get in, I get 3 to 4 cents, but I have a lot of shares in a company. So if a company's 50 cents a share, I'll buy say 2,000 shares of that company. That's $1,000. And for since I have 2,000 shares, if it's at 50 cents, if it goes up to 55 cents, then that's 5 cents profit times 2,000. I just made $100, also known as 10% of $1,000. So look at your percentages as well. Usually I pull out around 5 to 10% unless it's running, and then I let it run a little bit, and then sometimes you can get 20-30% out of it. Very rarely do you get more than that. They go up and down so much, and these companies, they're not really the greatest companies in the world. They're new companies. They're trying to get money from shareholders. Some of them are manipulated. So you wanted to make sure that you lock in your profits when you do you want to hit singles and doubles with your profit margins. You don't want to hit the home run. You don't want to try for the home run to make the big bucks right out the gate, right? Just one trade. You want to get singles and doubles, $10 here, $20 there, 20, 30, 10. That stuff adds up after weeks. And that's how I built my small account and my Robinhood, and also my Webull account. I also have a Charles Schwab individual account where I had $200, and now I had $2,000 in there last week before last. So I built it up pretty good by doing that. It takes a while, but it's the best way to not lose everything you have invested in it. And I'll make, since this video is kind of getting long a little bit, go ahead and wrap it up. I'll talk about pharmaceuticals. Anytime shares of a company shoot up really fast and they rocket, and you see it's going up 20-30%, you want to read up on some news on why it's going up that much. Sometimes different people in the company it's called a pump and dump, where they insiders and everybody buy into the company, make people believe it's going to do something, like news is going to come out that it's just released some kind of new technology, or they're just curing some disease or something, and then they'll dump it all at one time and take their profits before they dump it. So you want to make sure that you read up on a company and why it's going up so much and why it's spiking, especially in the pre-market. Pre-market hours are usually from 6. Start at 6 o'clock and then they end at 9:30. When the market opens, you can still buy and sell in pre-market. It's just a little more volatile, and prices don't move all that much. And sometimes you just want to kind of do your research in the pre-market. I don't like buying a whole lot in the pre-market. I like buying when the stock, when everybody's on it at 9:30 to 4 o'clock. Usually is when everybody's usually on it. Candlesticks, you want to look up charts. Robinhood sucks at charts. Webull is the best option for your charts. I love the simple moving average is what indicator I like using on the chart on Webull. So if you could go to indicators, simple moving average, learn how to read a candlestick pattern. Look that up on YouTube. I can show you that when I see you again. But the candlestick pattern is the best way to go. It shows you a lot more than Robinhood does. That's one of the main downfalls of Robinhood, is the charts, and that's kind of what's going to show you and give you the best way to win in the long term is chart watching and knowing how to read a chart. Watch out for stocks that are being delisted. If someone says that they're going to be delisted, that means basically they cut shares and they stop trading on the platform, on the main platforms, and go to the pink, what they call the pink sheets, or over the counter OTCs. You don't want to get involved in any of that. If it gets delisted, you want to get out as soon as you can if you hear anything about being delisted. Again, you shouldn't be holding bags for that long. You should cut your losses quickly, so if things get delisted, you wouldn't even have to worry about it anyway, because you're already out of the stock. I've had problems with holding bags too long, weeks at a time. I've learned that usually they do get delisted if it keeps dropping and dropping and dropping. There's a reason, and the company usually goes bankrupt or something like that, and they get delisted. So again, cut losses quickly on that. Do your own research, no matter what. You can listen to me, listen to Tim Sykes, listen to different people, give you opinions, listen to the comment section of what people are saying. A lot of people try to manipulate the stock by saying, if they got a lot of shares in it, they want the price to go up. They're going to say, oh, this is the best thing. This technology's coming out. These big news. The CEO just bought in a bunch of shares. Should get in now before it skyrockets. And then just don't listen to everybody. Do your own research. Look up your news. News is really big on stocks. If news comes out and it's great news, it usually means it's going to go up. But that's another thing. People make the stock market move, not news, not companies, not any of this stuff. People do. It's all about economy. It's about basically buying and selling. People make it move. So basically, if some good news comes out, I've seen news come out that it's a government contract or something like that. One of my shares I was in, a company I was in, news came out that they had just signed a government contract for cybersecurity. Should have went up, probably 40-50%. It did shoot up about 30% in the pre-market, and then I was thinking that it was going to go higher. And when the stocks opened at 9:30, it dropped and went down, and I was losing 2% on my money on that day. So can never tell. People get in, they get out, they take their profits, and that makes the shares less valuable. Obviously, supply and demand is what stocks run on. Supply and demand. If there's a lot of supply, the demand's low, then your stock's going to be worth less. If there's a lot of demand but there's not a lot of supply, then your stock's going to be a lot more valuable and shoot up more. And the reason the stocks go down is because people sell them, and there's people also that's called shorts. They short the stock, which means they're banking on the price to go down. You have to borrow money to do that from an individual brokerage account. I don't set that up. I don't borrow money. I don't like borrowing money, so it's very dangerous and risky. But that is called short selling. That's what drives the stock down as well. People are making money on the opposite end. We're trying to get the price to go up. They're trying to get the price to go down. That's what moves the shares. That's what moves the stock price, and makes profitability a lot less sometimes. If you want to look up short selling, what their interest is, look on the information. Webull again is good at telling you the short interest. Look up that, make sure that's not crazy, because people dragging the price down, it's hard for you to get profit and getting the price to go up. So just make sure you look out for shorting the stock. And again, the stocks move from people buying and selling. The more people buy, the more the price goes up. The more people sell it, that's when it goes down. So always make sure you look into short selling and make sure there's not a lot of people trying to short sell a stock. Set limit orders. Don't do market orders, especially on Robinhood. It's really bad for getting you in at a price that's not a good value. Sometimes if the price is, again, we'll use the 50 cent. If the stock is 50 cents and Robinhood says market price and the stock's moving, which they do when you're buying and selling. Robinhood opens at 9 o'clock, closes at 6 o'clock. That includes pre-market and post-market. 9 o'clock to 6 o'clock is when you can trade on Robinhood. Again, another reason I don't really like them a whole lot, because Webull goes from 6 o'clock in the morning to 8 o'clock is all the times you can trade through then, so a little more time periods on Webull. But Robinhood, again, I don't trade a whole lot on Robinhood. Only the thing I do like about them, and I'll explain that in the next video of why that is. Kind of said everything. The market orders, again, I was just talking about in Robinhood. The reason you don't want to do that is because you get in at 50 cent. You're thinking you're getting at 50 cent, but the price is moving. So they're going to get you in at the highest price that it's been probably in the last 2 minutes. Robinhood's really bad about that. You do a market order. So if you get in, try to get in for 50 cent, you set the market order, you buy 100 shares at 50 cent. and then you see, oh, I bought it at 52 cents. I wanted to buy it at 50 cents. Well, the market at that specific time when it went through more Robinhood, which has like so many seconds of delay, that's kind of what'll happen to you, and you'll get in at a higher price point than you want to. Always set a limit order. You can set your own price. If Robinhood, you set a 50 cent limit order, it goes up to 52 cent, 53 cent, 54 cent. You're still at 50 cent. You haven't bought anything yet. So that's a bad thing sometimes, but you don't want to have the FOMO, which is fear of missing out. A lot of times you can get caught up in that. You want to get good value. So you want to look at your charts, see when the price is right, a good value, get in at the bottom. You want to buy at the bottom, sell at the top. Or on the way to the top, sell at least, and lock in profits. But again, you want to set a limit order for what you think a good value of that stock is. Low float, that's what you want to look for in Webull. They got good information on that. Robinhood don't tell you that as well. You want to look at the 52-week high and low price of how low it's been in a year and how high it has been in a year. It kind of tells you where the stock is now and kind of what is and how low it can go. Sometimes they go below their 52-week low, and sometimes they go above their 52-week high. But that kind of just gives you a range of what it's been doing in a year. And again, charts will tell you that as well. On Webull, the reason I like using Webull is because they give you a little bit more info on the low float. Free float, which is what you want to look for. Tells you if a stock is more volatile or less volatile than others. Usually a low float and free floats. I like to trade stocks that are less than 25 million on the free float, and that when you pull up Webull, there's a little arrow that you hit, pulls the screen down. You'll see in the bottom left hand corner of that little screen it says free float, and you can look this up on YouTube of what this actually means. But the market capitalization, free float market capitalization, also if you want to get, that can get below, not over 100 million. Same thing with your float. Free float, anything under 25 million is going to be very volatile. If there's good news, it's going to move up quickly. If there's bad news, it's going to move down quickly. So I'm a day trader and a swing trader, so I look for that to be under 25 because I want the price to move and get in and get out, instead of holding things, stocks and stuff for over days at a time. More things can happen bad usually than good, or you just sit there and make no money for days on end. But again, it's your decision on, and do your own research. If you're more of a long trader, a swing trader or a long trader, you're going to hold a stock 3 days, 4 days, maybe a week, maybe 2 weeks. This is not going to matter to you as much, the free float. But again, you don't want to, a 200 million free float is not going to move much at all, especially penny stocks. It's not like Amazon, Apple. If you look at those free floats, basically they're millions, billions, and bigger the company, the bigger the free float means. And the free float means that's the shares that are outstanding that me and you can buy. So if the shares are only, if a smaller company, say 5 million shares to be bought and sold by people like me and you, then of course that supply and demand, the supply is low. So if the demand gets high, they come up with some new technology that's going to shoot the price up even further than a free float at 50 million shares outstanding, which is 50 million shares me and you can sell to the average people can buy and sell. Of course, 15 million is less than 50 million, so that's going to make it more volatile. Supply and demand again comes into play there. That's pretty much all for this video. In the next video, I'll kind of tell you about Webull and Robinhood, why I like each one of them and why I don't like the other.